Ora si registrerà la conferenza.
Tons of esma bocconi. I am very happy to be here with you for this last webinar of the conference Tons of esma bocconi. It's a very pleasure for me to introduce Massimo Guidolin from Bocconi University. Massimo will introduce the paper of Anna Bayona. Please, Massimo, the floor is yours. Thank you so much.
Thank you. Thank you, Daniela. Well, I will just steal a couple of minutes, also because the duration of the seminar is not extremely long. And so it's the last stop of this train. And we are closing with a very interesting talk, which is actually related to talks that we had in the recent past. So Anna Bayona will be presenting the paper Information and Optimal Trading Strategies with Dark Pools. And let me just say a few words about Anna herself. Anna is an assistant professor at ESADE in Spain, and she has a background which is mixed between hardcore mathematics and finance economics between Spain and the UK. And she's an expert, well-published expert in complete information in its applications to financial markets. And today the paper she presents, so I read through the paper, and it's related to previous talks in the sense they were always debating the advantages and disadvantages of opaqueness and transparency in the way we organize the architecture of financial markets. And specifically, Anna will tell us things about the relative merits, advantages and disadvantages of dark pools as opposed to limit order books, so very transparent mechanisms of organization of the functioning of the market. As in all respectable talks, I think it's fair to say that the conclusion of the talk will be, it depends. So I'm not spoiling, obviously, the results, because what is important to understand, I think, is what these depends on, which is what Anna will be telling us. Anna, I was told that you will have approximately half an hour. And for the people listening to us, remember that very important, there is an excellent discussion following by Martin Afelkorn from ESMA. So stay tuned also to hear the discussion. Anna, you have the floor.
Okay, thank you very much, Massimo, Daniela, first of all, for inviting me. It was a shame we couldn't come to Milan last year, but at least we do this seminar online. So the paper that I'm going to present today is Information and Optimal Trading Strategies with Dark Pools. It's joint work with Ariadna Dumitrescu, also at ESADE, and Carolina Manzano, who's in another university in the north of Spain. And so it's a theoretical model. It's quite a long paper, those of you that have read it. But the motivation is very important in financial markets. So in today's financial markets, traders have access to competing venues for trading stocks. So the venues for competing stocks are very fragmented. So one is not the one can only send an order to, let's say, the New York Stock Exchange or the Nasdaq, where the stock is listed. But there are multiple trading venues where you can send your trade. In particular, we're interested how different trading venues with different degrees of transparency compete. We're interested in the comparison between exchanges, which are lit markets, and dark pools trading alongside each other. A dark pool, just for those of you that don't know about dark pools, is a trading venue or mechanism that contains anonymous, non-displayed trading liquidity that is available for execution. So they are regulated, but the regulation is slightly different from exchanges. And the advantages that they offer is that they are anonymous and they do not have price impact. There are two key characteristics of these dark pools. The first is that they do not offer pre-trade transparency. This contrasts with limit order books, where you can see the stock being traded, you can see the bid, ask prices, and the different order sizes at each price level. And the other important characteristic is that they do not determine prices. These prices are derived from the transparent markets. So these two characteristics make it an interesting game that we analyze in a theoretical format. Just to give an idea of the trading volume of these dark pools, as of August 2020, trading volume in dark pools accounted for about 12.31% of the market share of the consolidated trading volume in the US and about 6.32% in European markets. There's some motivating quotes just to highlight their importance and relevance. Commissioner Luis Aguilar from the SEC said, today's markets enjoy historically narrow spreads, low transaction costs, and increased display liquidity. This suggests that the proliferation of lit exchanges and dark trading venues in recent years has not harmed investors, at least not to any measurable degree. But then there are several popular books by Michael Lewis and Patterson and so on, which basically say the hidden passages and trapdoors that riddle the exchanges enabled a handful of players to exploit everyone else, indicating that perhaps all these advantages are not there, and there may be problems in terms of welfare. Also, The Economist in 2013 said regulators have always worried that dark pools distort prices and exacerbate volatility by drawing away trading from exchanges, although academic studies on these questions have proved inconclusive. So we aim to contribute to this literature by shedding some light into this paper. The objectives of the paper is we have a market of a single risky asset that is traded, and there are two competing trading venues with different degrees of transparency. One is a fully transparent exchange organized such as a limit order book, and the other one is an opaque dark pool. Market participants, they differ in their liquidity needs. Some are liquidity constrained, whether others not necessarily, and also on the quality of the information. So we have informed and uninformed investors. We study how asymmetric information affects market participants' simultaneous choice of whether they want to trade or not, the trading venue, whether you want to trade in an exchange or in a dark pool, and the type of order in the exchange. And then with all this, we want to examine the effects of introducing a dark pool alongside an exchange on market quality. And we want to see, as Massimo said, how these depend on some characteristics. Some of these characteristics will be related to the stock market, and others will be to the trader. Those that are to the stock market are fundamental volatility, liquidity, and adverse selection. Those that are traders' characteristics are immediacy and also information. The related literature, I'll go quite fast. So there are two types. Of course, being a theoretical model, we compare better with other theoretical models. So there's this competition between dealer markets and other forms of exchanges. Examples of these are Henderson and Mendelssohn 2000 and De Vries et al. 2019. However, our paper fits better with the literature of the competition between exchanges and dark pools, such as Zhu 2014, Booty 2017, and Brawley 2018. We add a few dimensions to what they do. And then there is a whole empirical literature, which I'll discuss later in the presentation, which has tried to estimate that with empirical data and trying to find what are the effects on market quality. And they find that the effects are quite inconclusive depending on the market quality parameter, the specific data set, and the specific timing. What we do in relation to the literature is we study the interaction of a limit order book as an exchange with a dark pool in the presence of this long-lived asymmetric information in a two-period model. For those of you that have read the paper, you'll see that it is quite a difficult problem. So sometimes our conclusions are not as clear as they would, simply because it's an analytically difficult problem. So let's briefly describe the model. In our model, we have, as we said, a single risky asset with a liquidation value V, and this can take two values, a high value and a low value, with equal probabilities. The unconditional mean of this asset, we call it mu, and the volatility is sigma. This asset, as I've said, can be traded either all in the exchange. So sometimes we'll compare when we have two venues, the exchange and the dark pool, to when we have only the exchange in order to see the comparison better. And then we have some characteristics of the trading venues. So the exchange is organized as a limit order book. That means that the prices are on the grid. It means it's fully transparent. The initial depth at each price of the limit order book is 1. And then this limit order book, as it's usual, has price and time priority rules. That means that our limit order book starts full, but our model can also encompass these cases where it might be empty. In terms of the dark pool, is completely opaque in terms of pre-trade transparency. And as I said, in terms of pricing, the pricing of the dark pools do not determine prices. So an order submitted to the dark pool that is executed at time t has a price which is equal to the midpoint of the exchange. So the best ask at the time plus the best bid at the time divided by 2. So it uses the prices of the exchange to determine the price in the dark pool. If an order is not executed in the dark pool at time t, then the trader can either cancel or keep it. If it's kept, then it returns to the exchange a bit later, at time t plus 2. Now, in the dark pool, traders obtain price improvement in relation to some of the orders in the exchange, but the risk they face is that the order is not executed because there's not enough liquidity. So there's a possibility that their orders return to the exchange and the market price has moved against them. So dark pools entail sometimes price improvement, but there are 2 other types of risk. There's first risk of non-execution, and then there is also risk that the price has moved against the traders, given that it was not executed. In terms of traders, we have 3 types of traders. Well, we have rational traders. These choose the optimal strategy, maximizing expected profits given the information they have at each point in time. And out of these rational traders, there are 2 types. Informed. These have perfect information about the liquidation value of the asset. They know exactly the value. And those that are uninformed, they only know the distribution of the liquidation value of the asset, conditional on the information provided on the limit order book. In other words, informed only use public information, whether those that are informed use both public and private information. And finally, we have liquidity traders. This is not that they are irrational, but simply they trade for liquidity or hedging needs, and they either need to buy or sell with probability a half, and they only trade in the exchange because it's faster and it guarantees execution. So the timeline of the model, we have a 2-period model, let's say, where there are 2 types of decisions. At time 0, nature draws the state of the world in terms of the asset, where the value is high or low. At time equals 1, a trader arrives. If he's rational, he would choose an optimal strategy based on his information, that is, whether he's informed or uninformed. If he's a liquidity trader, he trades according to his liquidity needs, either buy market order or sell market order. At time 2, a new trader arrives. So there's a new trader, which is not the same as in T1. Then if he's rational again, he chooses his optimal strategy based on his information set. If he's a liquidity trader, again, he trades according to his liquidity needs. And then finally, if there was at time 1, if there was a dark order which was submitted but not executed, it can return back to the exchange at time 2. And then finally, at time 3, the liquidation value of the asset is made public. At time 2, then if the dark pool was executed, was submitted and not executed, then the order returns to the exchange. And finally, the trading game is over. Now, in terms of types of orders, first we choose whether a trader wants to trade or not. So traders choose to trade if their profits, the expected profits are strictly positive. Otherwise, they prefer not to trade. In terms of orders in the exchange, I know nowadays there are many types of orders, but the 2 classic types are market orders and limit orders. So traders can submit market orders. These are executed immediately at the best available ask and bid prices. Secondly, they can submit limit orders. That is, a limit order improves the current market price, so they often have better price than market orders, but they face execution risk. In other words, they improve the current market price, may be executed in the next period if a market order of the opposite sign hits the limit order book. So a limit order always improves the price by a tick, tau is a tick, and they provide better prices than market order, but they have execution risk. Finally, if a trader decides to send the order to the dark, this order behaves like a market order in the dark, and there is a probability that this order submitted by a rational investor to the dark pool at time t is executed. If the order is not executed, then the order returns to the exchange either as a market order or as a no trade order. And the price of this dark order, as I said earlier, it's derived from the exchange. And the way we model it is equal to the midpoint between the ask and the bid prices prevailing at the exchange at time t. Now, the sequence of events, so we have first that there's the liquidation value of the asset. With some probability, a rational trader arrives. With some other probability, we have a liquidity trader. This liquidity trader, as we've said, is half the time a buyer, half the time a seller. Rational traders, with some probability, they're informed. With other probability, they are uninformed. And then for an informed trader, the possible strategies are market order, limit order, dark order, no trade. And then the dark order can be executed or not executed. And the same for the uninformed trader. Now, this is one period. Since we have two trading periods, we could draw the same graph for the second period, and it would be the same. As you can see, it's quite a complicated game to try to analyze, especially given since we have asymmetric information. Now, the concept, the equilibrium concept that we use is perfect Bayesian equilibrium, because we have a sequential game of incomplete information, and we focus for simplicity on pure strategies. So let's now analyze a reduced game where traders can only trade in the exchange. So we forget there is a dark pool, and we try to see how would the equilibrium be if traders could only trade in the exchange. So first of all, the strategies that are available are market order, limit order, or no trade for any rational trader. And then we have the following lemma that the following results hold. If you're an informed trader, in the second period, you will submit always a market order, because there's no future limit orders are irrelevant. In the first period, if you're an informed trader, you'll either submit a market order or limit order. So your choice is market or limit order. If you are an uninformed trader, you will submit either a market order or no trade in the second period. That is, this decision depends on the level of adverse selection. In other words, if there's the limit order book that does not contain enough information and you are uninformed, because adverse selection would be high, you tend to select no trade. However, if from the limit order book you can deduce that the direction of the order informs you about the value of the asset, then most likely you will submit a market order. Now, in period one, for the uninformed trader will only choose a limit order and no trade. Notice that for the uninformed trader in the first period, the expected profits of a market order are negative, and so that would never choose. So combining the possible strategies that can be sustained as an equilibrium and t equals 1, using the information from the lemma, we have 4 possible equilibrias. The first equilibria is where the first two dimensions on the brackets correspond to informed traders. One is a buyer, the other one is a seller. So you can submit a buy market order, sell market order. And the second two orders correspond to uninformed traders. The first for the buyer, the second for the seller. So our 4 strategies are informed submits market order, uninformed limit order, informed submits limit order, uninformed submits limit order as well. The second equilibrium would be informed submits market order, uninformed submits no trade, and the fourth equilibrium would be informed submits limit order, uninformed submits no trade. Okay, so we have these 4 possible strategies. Now, proposition 1 finds out the equilibrium both in t equals 1 and equals 2 in this benchmark model in the single venue market where we only trade in the exchange. So because it's quite complex, we decided to present the information graphically. In this graph, we can see the dimension on the horizontal axis is the fundamental asset volatility, and on the vertical axis is PIN, which is the probability that a rational trader is informed. In other words, the probability of an informed trade. What we notice immediately is that the decision of the informed trader depends on the volatility of the asset. In other words, if the volatility of the asset is low, then the informed trader will choose a limit order. If the volatility of the asset is high, then the informed trader will choose a market order. Okay, we see this between the red color and the blue color. Now, for the uninformed trader, the decision not only depends on volatility, but also depends on this PIN. And this PIN is a measure of adverse selection. So it depends on both factors. For the uninformed trader, we notice that An informed trader submits a limit order when there is low adverse selection and the volatility is low. Okay, so either the volatility is very low or the volatility is low and adverse selection both low. Now, if either we have high adverse selection and the volatility is high, then uninformed traders prefer not to trade and they choose no trade. So here we have a categorization of what are the strategies when the dark pool is not available, given market conditions. Notice that there are some thresholds which depend on the volatility. So some thresholds for the informed trader, which makes him switch from low volatility to high volatility, in other words, from limit order to market order, and also for the uninformed trader, from limit order to no trade. So we have some thresholds which depend on immediacy, which depend on all the characteristics between the trader and the market. So given that, we can characterize stocks in 4 dimensions. So as you saw in the previous graph, we had we have volatility and pin, and so we can construct a 2-by-2 table, let's say, where we have high-low stock. The first dimension refers to the volatility, and the second dimension refers to adverse selection or pin. So let's say a high-low stock is one where initially the informed trader demand liquidity, so market order, and the uninformed trader supply liquidity, a limit order. A high stock corresponds to high volatility and high adverse selection, and so it corresponds to market order by the informed traders and no trade by the uninformed traders. A low stock is low volatility, low adverse selection, so this corresponds to both limit orders, so kind of a pooling equilibrium. And the low-high stock corresponds to basically limit order by the informed traders and no trade by the uninformed traders. Notice that in the previous graph that I showed you, there are only 3 regions, not 4. And this is because this last equilibrium, the low-high stock, is very improbable given plausible market parameters. Okay, so even though theoretically it's possible, given the kind of liquidity that occurs in the market, volatility that occurs, and so on, is very unlikely that it actually occurs. So now we are ready to go to the 2-venue market, where we have both a dark pool and an exchange competing alongside each other for liquidity. So we're trying to see how things change when traders can migrate their orders to the dark. So let's see some preliminaries. First of all, the decision to submit an order to the dark pool depends on the probability of execution. So our model has a feature that the probability of execution in the first trading period is exogenous. In other words, is given. However, we try to endogenize this probability in the second trading period. Okay, so, and then from that we can construct a lemma which basically says that the probability of execution of a dark pool order time 2 is greater for an uninformed trader than for an informed trader given the same market conditions. Okay, and then we also have a similar lemma to the previous case, where we have which orders are possible in each of the equilibria. And so what we have is that the informed trader at t equals 2 can either choose a market order or a dark order, while in t equals 1, the informed trader can choose market order, limit order, or dark order. So we enlarge the set to include the dark order. Now the uninformed trader at t equals 2, it's the same, basically. It can choose a market order, the dark order, but also no trade. And at time 1, this uninformed trader can choose, well, in principle can choose everything, but in practice it will never choose a dark order because of this uninformed trader. The expected profits of a dark order are negative for an uninformed trader. So composing these strategies at t equals 1, we can find 6 potential candidates that can be in equilibrium. And that is the combinations of market order, limit order, and dark order for the informed trader, and the combinations of limit order, no trade for the uninformed trader. Okay. So, so now we're going to show you some graphs. These are the same graphs that I presented for the single venue market. The only difference here is that the dark pool is included. And so what we're trying to see is how the migration to the dark pool, which are the colors represented by the dark pool are black and gray, so gray in the last figure and black in the other, change as we move. So what's the difference between these graphs is that we move the probability of execution in the dark pool at t=1. So we notice that when the probability is very low, we get the same strategies as when there is not a dark pool, which makes sense. However, as this probability increases, and notice that in the second graph, the probability of execution dark pool is only 10%, we notice that there are some orders which go to the dark pool first. No? So we notice that for low volatility stocks, then we first have migration to the dark pool, and so on. And this is kind of a triangular region. So as we increase this probability, this increases, and at the end we have that when the probability is relatively high, and notice that here is with the simulations is 25%, then we have that all the informed traders migrate to the dark pool in the first trading period. Notice that the best prices are offered by the limit order, followed by a dark order, followed by a market order. So market order gives you a lot of certainty, but does not give you enough price advantage. Where the limit order gives you both, and the dark order is squeezed between the two. Notice, as I said before, the uninformed trader in the first trading period of our game never goes to the dark pool. So then we show another graph, which is a different kind of exercise. You just see the slide is not coming. So this is a graph where here we do a different exercise. We show on the horizontal axis the asset volatility, on the vertical axis the probability of execution in the dark pool for an informed trader in the first trading period. And again, what we notice is that, well, when the probability of execution in the dark pool is low, we get exactly the same strategies as when the dark pool did not exist. However, we notice that for those orders where the informed submits market order, as volatility increases, the probability at which you switch to the dark increases with this probability. However, when the informed chooses a limit order, this is kind of the red bit of the left-hand side of the graph, bottom left-hand side of the graph, then we notice that this probability of execution of the dark decreases the migration to the dark pool. So we have some idea of what happens, in which circumstances orders will migrate to the dark. So now the next interesting thing is to understand what are these effects on market quality. Because of the sake of time, I think I have relatively little time. I'll just concentrate on a summary table, and I'll try to explain it as I go along. So I have various things. Well, let me explain the first thing, and then I'll concentrate on a summary table. So first of all, we study how this addition of the dark pool changes the following dimensions of market quality. We look at price informativeness. We look at market liquidity in the exchange. We look at expected volume. We look at trade creation, and we look at profits of these things. And what we do is we compare market quality in the dark pool and the exchange when they coexist to the case where we only had the exchange. Okay? And that will give us also some policy implications. Our predictions show how adding a dark pool alongside an exchange affects market quality depending on stock and trader characteristics in both trading periods. For simplicity, since our paper is very much dependent on these conditions, I'll just present the results for t=1, which I think they're quite rich. So our results also generate empirical predictions that can be tested in empirical work, and also new predictions that can be tested if we had enough data. So I'll skip the details of these market quality, and I'll go straight away to the summary page. So here's a summary of all our findings in the first trading period. We have an equivalent table for the second trading period. As we say, we can classify our stocks into these two dimensions, no? Volatility, low and high, adverse selection, low and high. So we have a categorization of 4. Now we notice that in all the cases, in the first trading period, price informativeness is lower with the existence of the dark pool than without the dark pool. The reason of that is the order segmentation. In other words, the reason of that is because the informed trader migrates to the dark pool, and as a result, the exchange contains less information. In the second trading period, we can get the opposite result. We can also get the price informatives might increase. And the only way in which this can happen is if the uninformed trader migrates to the dark and the informed trader stays in the exchange. In that case, then prices contain more information than when we have both types of traders. For liquidity, our measure of liquidity is the expected inside spread, as is common in the literature. We notice that the effects depend on whether we have low volatility stocks or high volatility stocks. And we notice that for low volatility stocks, the expected inside spread increases, meaning that liquidity decreases. And the opposite happens for high volatility stocks. For total welfare, I mean, we call it welfare, but here we mean profits. We notice that in the first period, the expected profits of informed traders are always greater. Okay. For uninformed traders are always greater or equal. Whether for liquidity traders, usually they're the same because those don't change their trading strategy. Notice again, these results can be flipped in the second trading period. Finally, for expected total volume, this is whether there is trade creation or trade destruction. Again, that depends on whether we have low or high volatility. So for low volatility stocks, we have an increase in expected total volume, so trade creation. Whether for high volatility stocks, we have trade destruction. And then these results come because of the order migration to the dark. Well, the dark pool does not execute with certainty, so that has an effect on this. Now, these implications, again, we can construct this table for the second trading period. It's a bit more complicated to explain, but these results lead to a policy implication, which I think is quite interesting. So we can relate our results to the fact that, for example, the European Commission has implemented the regulation in 2018 to limit that tradings through this double volume cap mechanism as part of MiFID II MiFIR, which was implemented since 2018 and I think finalized recently. This DVC rule mechanism introduces limits on the trading volume of an instrument in any single dark pool to 4% of its total trading volume in the previous year. So we assume that imposing a cap on dark trading is equivalent to a cap on the execution probability in the dark in the first trading period. So if that's the case, if this cap is binding, then the policy limits the initial benefits, but also the initial drawbacks of introducing a dark pool alongside an exchange. In particular, introducing this cap, according to our model, would have the following effects. Price informativeness will be higher if it's binding. Second, the spread will be higher for high volatility stocks, but will be lower for low volatility stocks. So it depends on the type of stock. The trading volume will be higher for high volatility stocks and will be the same for low volatility stocks. And in terms of trade creation, there will be trade creation for high volatility stocks and trade destruction for low volatility stocks. So it kind of limits there's some advantages and disadvantages that need to be looked in a comprehensive way. So to summarize what we have done in a very short presentation is that we studied the interaction of a fully transparent exchange organized as a limit order book that competes with a dark pool for liquidity in the presence of asymmetric information. This limit order book with asymmetric information makes the problem quite complicated. So market participants' strategic and simultaneous choice of trading venue and order type presents this trade-off between price improvement in the dark and the execution risk in the dark compared to the benefits of sending an order to the lit market, to the exchange. Also, we notice that adverse selection and information leakage faced by different types of traders are different, and that leads to different conclusions. So we've also seen that adding a dark pool alongside an exchange may shift the optimal trading strategies of each type of rational trader. So informed traders, they go from market or limit order to the dark pool, and uninformed traders, even in the second trading period, they may go to the dark pool. In the first trading period, even if they do not go to the dark pool, they may switch strategy, in particular from limit order to no trade. And then market quality parameters vary according to stock and trader characteristics. And so our results lead to new empirical and policy predictions. Thank you very much. I'm very much looking forward to the discussion and questions and inputs on how to improve the paper.
Thank you, Anna. I think the floor goes back to Daniela, who's the organizer. So Daniela, tell us what happens now.
Many thanks, Anna, for your presentation, and in particular for policy implication will be very interesting for the regulator. And so I don't know if there are questions, but we can, the audience may okay, or could make question at the end of discussion. So I think it's better to go on and to present the discussion by Martin Apercon. Is a risk analysis at ESMA. Welcome to us. Thank you. Many thanks, Marty, but not also for discussion, also for supporting all the webinar and the presentation of Anna. So please, the floor is yours. Thank you so much.
Yes,
Welcome.
Thank you so much for the very kind words. Just as a matter of fact, of course, I need to tell you right before that the views expressed are those of mine, so they are not in any way related to ESMA. These are my private views as a researcher, not related to any policy things. So with that little thing beforehand, I move on to the next slide. So the paper in a nutshell, the research question is basically how the introduction of a dark pool in the 2-pine model affects the trading at the micro and also at the macro level. So basically, we look at the different trader types, and basically we analyze certain factors, for example, the strategies that they would employ, the price informativeness, so this is more a macro variable, the profit of each trader group, and the market liquidity here measured by a spread, and of course the trading volume and trading creation and trading destruction. As a matter of fact, and sorry, Anna, I think I need to take the control from you because I think you are on your computer. Let me just, okay, now you can work on your computer, Anna. So with that, I must say it's a well-written and executed paper. I really enjoyed reading it. In particular, I enjoyed reading first the one venue case, so the very easier model, and then basically moving on to the next model. Just as a fair warning beforehand, I'm more empirical researcher, so my comments might not be so in depth about the mathematics behind it, because I think that I'm not in the position to evaluate it. But for me, it sounded everything sound. With that, I move on to the next slide. Of course, for a theoretical paper in general, of course, we need to basically challenge a little bit the assumptions made, either explicit or implicit made in the paper. And here, basically, I'm just taking one of the things out and basically comparing the paper with, let's say, the reality or the complexity which we face also in the markets. So the core question here is always how the assumptions basically align with the reality. Here we basically see first the one market model, then the two markets, and basically two market model refers to a reference market and the dark pool. The core question is, of course, to which extent this reflects the market structure today in the market. And I can only speak for the US market and also, of course, for the European market, because this is where we are residing and also ESMA basically looking at. So I was wondering to which extent a new type of market would make sense, or at least basically discuss these shortcomings in the paper or limitations. Today, we are basically faced in Europe, for example, with many different types of markets. So we have MTFs, we have so-called main markets, which basically have the most of the volume. Then we have this kind of satellite markets, which basically also play a role here. So here I see a potential shortcoming, if you will, so with the reality. Of course, I understand that this is a theoretical paper, and also I know that the new market potentially won't be easy to model and even be answered in one paper. So maybe this is something which could be addressed in a limitation section more clearly, and basically also referring to this, because then when you have, for example, a main market and then a satellite market, you have different types of liquidity there and also volatility and also, of course, trader types. So this is potentially something that interferes with a model, and potentially traders would behave differently if they have a satellite market, for example, or another market to choose from with less liquidity. But this is something which I think it cannot be addressed in this paper at this stage. So potentially it could be nevertheless discussed in the limitation section. Then the next thing on the model assumption, of course, we basically limit ourselves to specific types of orders. In the real markets, let's say, or in the markets which we basically observe, in Europe, we see that we have many distinct and also different types of orders. So I don't know to which extent you want to extend the paper there, or it's even the willingness is there to do it, because I also understand it could be quite complex. But for example, some things which I was thinking of, so what is with hidden orders in the spread, which we see, for example, for some of the lit order books in Europe? Would that change somehow the dark pool usage? Potentially, yes. I think also what is with iceberg orders, of course, one of the biggest things I think, and this is potentially also a game changer in European markets, is the introduction of smart orders or smart order routers, which basically route to orders also of uninformed traders via informed traders. So this is something which certainly I think would be interesting to discover. One thing which I was wondering about basically was that informed traders indeed use market orders. And first, something to mention here, of course, a market order is always a limit order with a very high or low limit. So this is something to take into consideration here. So here I don't really understand the rationale why an informed trader would basically use a market order, because this is maybe my ignorance here. My understanding is that informed traders know the true value of a share. So certainly, I guess they want to limit their exposure there. If they know that the value of the share is, let's say, 10 euro, they wouldn't buy with a market order up to 12 euro a share. I guess that wouldn't, at least from the logical perspective, for me, can make much sense. So potentially this is something which maybe needs more explanation in the paper, or I'm missing something here. Also, of course, this could be the case. Then I'm moving over to market performance measures. Currently, you are looking at market liquidity, and this is basically measured by the spread. Of course, and this is something which you can also see, of course, in empirical literature, you have much more liquidity measures. Actually, there's a vast amount of liquidity measures there. One of the things which I thought potentially could be interesting is the depth of the order book, or the amount of quotes, to basically give here another extension. This is something which I think would help also to look a little bit more on the wider aspects, like the macro level, basically, and give basically regulators and also maybe market operators a bit more insight how these traders would behave on and how this trading behavior basically changes the market, which they are basically regulating or basically providing to their end clients. Then, of course, something on the European double volume cap. You basically devoted, I think, a section to this, and it was very interesting to see what you thought at this. From the regulatory perspective, maybe it would be interesting if with the model, basically, you can determine the effects of a certain double volume cap. I'm thinking here, for example, you could basically simulate or basically produce your charts depending on a certain level of double volume cap. As you already explained to us and also wrote in the paper, there's already a variable there that could be used for this. So that is potentially something where, at least from the regulatory perspective, would be very interesting to see whether we see the effects becoming better or worse. And that's basically it on this comment. Also, one thing which I wanted to mention in this context, basically, of the double volume cap, there's also another empirical paper which was produced by ESMA and Claudia Cuccigliano basically did a major work there, and I think she's well known to CONSOB and also bocconi members. So this is something which you could also, of course, cite and also potentially look into to basically see how your predictions match up with empirical evidence there. Two small minor comments, basically. So in the beginning of the paper, I was not particularly surprised, but I would have expected more that you directly mentioned that HFTs could be seen as informed traders. I guess it would be good to put such information maybe a little bit more prominent at the beginning of the paper, because this will somehow basically draws attention directly to the paper, because sometimes you are not entirely aware what means informed trader in this sense. Also, I was wondering to which extent you made numerical simulations. I mean, you have shown charts, so I understand basically these would derived from numerical simulations, but maybe you could explain a bit also more on the paper what was particularly done there. And I guess that's it with my slides on the discussion, and I'm also happy to receive any comments if there are any.
Martin,
Yes.
many thanks for discussion. Very, very interesting discussion. And now, I don't know if Anna, would you like to reply to Martin?
Yes, Martin. Well, thank you very much for the discussion. Definitely, some issues is worth discussing. No, some of these issues can be addressed. Others are limitations. It would make the model even more tractable. But I do appreciate. So if I can summarize a little bit, know what Martin has said. No, it is true that we do skip some of the details of what's currently happening in markets. For example, in types of orders, we are aware that we do not model all the types of orders that exist, such as iceberg orders or smart orders and so on. It is true also that there are other types of market structures like the satellite markets and so on, which we do not model. I think with theoretical models now we try to make a variation which is tractable and try to find the effects of that. So we could think of some of them maybe as potential extensions, but so far I think they're good suggestions as limitations, but it would take quite a lot of time and impossibility, I think, to model some. Others, we need to think how to integrate them in our model. Other things which are very interesting, other measures of market liquidity. I think this is really interesting, and maybe we can have a discussion later on, maybe by email about which are the measures and how to implement them and so on. I think that's very good. And I think your comments on the double cap are very interesting. So definitely we could try to simulate this graphically, trying to see the effects a little bit more, and we'll read the paper that you cite. I think that's very important. In terms of explaining more numerical simulations in the paper, like how would we do these graphs and so on. So initially we had different kinds of graphs which were more theoretical and tried to illustrate all the possible equilibria. And then through the editorial process, the paper is under review. Some of the referees said, okay, but we want these parameters to be more realistic. So we had to kind of change the graphs to make the parameters realistic. But I guess it's true that we could justify more in the paper why the parameters we choose are kind of realistic. Where do they come from? And then of high frequency trading, yes, we're a bit unsure about this. It's true that in the policy implication we have something on high frequency trading. But I'm not sure now whether we are stretching the model a bit too much to imply something about high frequency trading, because we do not have fast and slow traders. So maybe this is a part of the paper which I mean, it's related to dark pools, but maybe we leave out, and maybe we're trying to stretch too much. But definitely, well, thank you very much for the presentation. If you could share it with us, we would appreciate your comments, and maybe we can discuss further some of the comments that you make.
Sure. Many thanks for the explanations. I will share the presentation with you.
Great.
Perfect, Hannah. Thank you, Martin. Now I ask the support by Massimo. Massimo, do you think that now we can ask if there are questions in the audience? Usually there are not a lot of questions, but I think that you are able to obtain more questions, or at least to make yourself.
No, I do have a question. I mean, it's not a great question, but possibly there are in the audience specialists in market microstructure who can ask smarter questions. But so let's wait for a minute for people to unshy themselves. Or let's do like that. While people unshy themselves, let me ask. Oh, Carlo, yes, please.
Yeah, thank you very much. Thank you for the presentation. Very rich of insights. So I would be very keen on reading the paper because it is very super complex, as Anna mentioned. I have a question concerning the size of the orders, whether this complication is somewhat captured by the probability of execution in your model, or do you think it should? Because what we typically expect in dark pool is that these markets are populated by institutional investors rather than other type of investor, informed or liquidity investors. So this is the main question here. Thank you.
So yes, it's indeed a very good question. Also, so we, as a simplification of our model, and again, we do that for tractability, we assume that the depth at which each price level is 1, and so traders submit orders of size 1. So we are aware that the main motivation for sending orders to the dark pool, well, they're various. But one of them is that you know, if you're a large trader, you want to hide your order from the exchange so that you do not front run yourself, so that there are not other traders that front run you. And so this is definitely a motivation for going to the dark. So if you had orders of different sizes, definitely that would be that would make the model a bit less tractable. But one piece of evidence which is, I think, is interesting that we have is that nowadays the average size of the orders that are executed in the dark pool is very similar size to the orders that are in the exchange, and this is because of various reasons. First, it is true that in the dark we have the large institutional traders, and these have very large orders. But it is also true that in the dark there are high frequency traders with very, very small orders, so these kind of bring down the minimum size. And also brokers have started to switch, to route their clients' orders, retail clients' orders, into the dark. Not directly, but the broker routes them to the dark. So actually now we have, in many of the dark pools, we have quite a variety of orders. So it is true that we could consider orders of different sizes, and we don't do it for tractability. But we have some evidence in favor, which is that nowadays orders in the dark and in the exchange are on average a similar size, but of course the distribution is very different.
Well, thank you very much. I have another question on the literature. The first part of your paper, where you have the single venue case, what is your reference in the literature? I mean, what is the setup where you are?
So, our framework, our main framework and the modeling choices, we follow on Foucault 99. This is, we kind of try to do an extension on Foucault 99. And so this is kind of a little bit how we did most of the modeling choices that we have done. And then our results, in the first trading period, they are a bit similar to what Godler and co-authors find in 2019 in terms of which orders are routed to the exchange, which orders are market orders, limit orders, and so on. But our framework is, let's say, comes from Foucault 99.
Thank you very much. Okay.
There are other questions? Massimo, I don't know. Thank you, Carlo, for question. Really.
Then I can ask mine, but it's not, I mean, it's a question for the entire literature. It's not really about your paper. But so obviously you're trying to squeeze out policy implications, and many of the members of the audience, they care for that. But I always wonder, so when you have these parameters which are affecting the outcomes, the results that you report, how policy relevant are they? So in this case, for instance, I was thinking about PIN, the probability of informed trading. And I know that there are ways to estimate academically that, but when you go to a policy environment in which informed trading sometimes should be completely banned, so I wonder, so how can a policymaker use something which is based on a quantity that in principle should be equal to 0, and then we know it's not 0, but to play with the estimate of such a parameter is always politically delicate, right? So what is the thinking about it when such a quantity carries an interest, like in this case?
So I mean, I'm not an empirical simulation person. I think the role of a theoretical model is to propose channels which have not been thought before, and to kind of lead to potential, let's say, here, so we have some policy implications. So something, a channel that maybe policymakers did not think about. But I think we do need, like, let's say, I think this paper would need another kind of empirical paper which really calibrated, as you say, with maybe the right values of the pin and the kind of different types of volatilities and so on, to then translate it into policy. I think our model is not ready to just, grab the result and take it to policy, but it perhaps makes policy made, because to think of this adverse selection channel, which was not present in other models, as a tool of how informed and uninformed traders trade when you have competing venues of different degrees of transparency. So it is more about describing a channel that was not there before and trying to be aware that on how it depends on these characteristics. But I think our model is not capable of basically, well, we do not do a calibration or think about how realistic these parameters are. I don't know whether it answers your question.
No, it does in a way, right? I mean, basically you're saying don't take it so seriously, and the variable is there, everybody is using it. But, to justify, say, dark pools on the basis that there is what is criminal activities in some countries is, I don't know, I mean, I can imagine somebody standing up and giving a policy speech in which the point that comes out is this one. That would be difficult. So, but I mean, you're right. You say, look, it's out there, so we have to model it. Otherwise, we don't understand the channel at all. Fair enough. Daniela, come back.
Yes, okay. Many thanks. I think the time is constrained already, so I think we can go to thank you. In particular, many thanks to your participants. Many thanks to Massimo Guidolin, not only because Massimo present the paper of Anna Bayona, but also because
Anna presented. I just introduced Anna. Okay, let's not confuse.
Just introduce, but also coordinate, co-author, I think it's a moderator, co-moderate this webinar with me. So, and then I would like to give many thanks to Anna Bayona for your participation and presentation of this very interesting paper in market microstructure. It's very interesting to know this study on the market efficiency and information in the market. And also, I would like to give many thanks to Marty Heppercorn for ESMA. Thank you very many thanks. And also for question by Marco Milia. Thank you so much also to Nadia Linciano, is the head of economic study. Nadia, Massimo, and Claudia Bayano is a core organizer of this conference. This is the last webinar of the conference Council of ESMA bocconi. I hope this conference will be not online next year, maybe, because if we have resolved the COVID problem. So many thanks to all. I will see you. Goodbye. Also many thanks to Luigi De Bernardis, is the co-organizer also of in Council. Luigi, there are, I don't know.
Grazie.
In order, and thank you so much. Have a great day and have a great week. Many thanks. Bye.
Thank you. Bye.
Thank you. Bye.
Thomas.